Hello and welcome to the MicroLearning Institute. In this short tutorial we look at the essential principles of IFRS 13 fair value measurement. The objective of IFRS 13 is to define fair value and also to provide guidance on how to determine fair values and also what disclosure requirements are required in relation to fair value. IFRS 13 applies where another IFRS requires fair value measurement, except in the following cases. 1. Share-based payments, where IFRS 2 asks us to look at the fair value of a share option at grant date. In this case, IFRS 13 does not apply to the calculation of that fair value. Leasing transactions, where we look at the fair value of the lease at inception, or any other standards that use measures that are similar to fair value, such as IAS 2, the lower of fair value less cost to sell, or net realizable value, etc. Fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This price is also referred to as the exit price. An orderly transaction assumes that exposure to the market has been for a period before the date of measurement to allow for normal marketing activities and to ensure that it is not a forced transaction. Again, IFRS 13 introduces the idea of the principal market, and this is the market with the greatest volume and level of activity for the asset or the liability, and it's assumed to be the market where the entity normally transacts. If there's no principal market for an asset, then IFRS 13 uses the most advantageous market. And the most advantageous market is the one that maximizes the amount that would be received for the asset or paid to extinguish the liability after transport and transaction costs. IFRS 13 prohibits adjustments of fair value for transaction costs because, it argues, these costs are a characteristic of the transaction and not of the asset or liability. IFRS 13 allows fair value to be adjusted for transport cost, particularly where location is a characteristic of the asset. IFRS 13 requires that market participants are independent, that they are knowledgeable, and that they are able and willing to transact. Fair value, so IFRS 13 sets out a valuation approach based on a broad range of techniques, including the market, income-based approaches, and cost-based approaches. Fair value measurements are categorized into a three-level hierarchy based on the type of inputs to the valuation techniques used. Level 1 inputs, or the highest level, these are unadjusted quoted prices in active markets for items identical to the asset or liability being measured. Active markets are ones where transactions take place with sufficient frequency and volume for pricing information to be provided. Level 2 inputs are inputs other than quoted prices in level 1 that are observable for that asset or liability. Again, level 2 inputs are supported by market data. Adjustments may be needed to level 2 inputs. Level 3 then is where situations occur when relevant inputs are not observable. They must be developed to reflect the assumptions that market participants would use when determining an appropriate price for the asset or liability. Level 3 inputs are unobservable, which should be used to a minimum. When measuring fair value, the entity is required to maximize the use of observable inputs and minimize the use of unobservable inputs. each fair value measurement is categorized on the basis of the lowest level of input that is significant to it. IFRS 13 does not preclude an entity from using its own data. For example, cash flow forecasts may be used to value an entity that is not listed. In respect of disclosures, the required IFRS 13 disclosures include information about the hierarchy level into which fair value measurements fall, methods and inputs to the fair value measurements and changes in valuation technique, and quantitative information about unobservable inputs and any assumptions used. For non-financial assets only, fair value is decided based on the highest and best use of the asset as determined by the market participants. The fair value is based on the perspective of a market participant who holds the identical instrument as an asset. If there is no corresponding asset, a valuation technique is used, as is the case with a decommissioning activity. Transaction price is not always the best indicator of fair value at recognition, because entry and exit prices are conceptually different. Thank you very much for watching this short tutorial on IFRS 13 presented by the MicroLearning Institute.